Hello friends, welcome to this new video. It's a continuation of the last video which we had. And in the last video, we had discussed about two interesting small cap companies in the auto space. And we discussed the first company, which was Men Bearings. So in this video, I'll be discussing about the second company. And again, please note, these two companies have been selected because based on their recent investor presentation or recent investor conference call, there were certain discussions regarding something interesting happening in the business from future growth perspective. And now whatever things are being discussed, these are management aspirations. They may or may not play out. That is point number one. And point number two, these may play out over 3, 4, 5 years. So don't take it from a 2-month perspective, whether price went up, price went down, because those kind of discussions are immaterial. Take these videos just as a starting point, and then everybody needs to do their homework. We need to track the companies, and we need to build our own conviction. So like last week, I had shared about Men Bearings. There is one more stock which came on the radar. I am sharing disclaimers. So this is the education session. Take it for the initial analysis. Post that, everybody needs to do their due diligence. I do have a tracking position because I want to track this company now properly from con call perspective and all, and quarterly level. So the company is Talbros Automotive, and if we see this company, it's a well diversified company, very small company, but still well diversified company, which is present into gasket and forging market. And if we see they're well diversified, whether it's two-wheeler, three-wheeler, passenger vehicle, HCV, agri, so well diversified. Even in terms of OEM export, decent revenue comes from the export market, small aftermarket presence. Gasket is the biggest business, 50%. Then they're into forging. So they started with gasket. And then I think 8-9 years back, they got into forgings. And these three which you are seeing is basically they are special JVs which they have done with some of the foreign auto companies to drive specific business. So this NLK is Nippon Leakless Corporation, where they make gaskets for certain specific customers. Same way, MTCS is Marelli Talbros Chassis System. Marelli is a very, very big company in automotive space globally. So this is a 50-50 JV with Marelli, where they make axle and all. And then this TMR is basically Talbros Morgo Rubber, which is again, a specific 50-50 JV for certain components. So these two are small. This is bigger one. And given it's a JV with Marelli, this is something which is also worth watching. So these three are very, very important businesses. And these are the segments. So very well diversified portfolio, even though companies of small size. And this is how the company has grown, where in FY7, it used to be a pure gasket company. And then from pure gasket company, they have kept on adding this product basket, and slowly they have multiple product baskets, which highlights, the evolution of company, how they have grown in terms of growing the product base. And most of the companies, whatever we can think of in two-wheeler space, passenger space, we have very good client base here. And none of the, despite again, usually when I see auto ancillary companies of, small size under 1,000 crore, one of the most common risk I see is either they will be there in one specific auto type, like two-wheeler or four-wheeler, or they will have 3-4 customers which will supply, which consume 70-80% of the revenue, or they will be present only in certain specific, either domestic. So, but this company, another thing which I liked was there is not that kind of relative client concentration risk. And here you can see the client base is pretty much diversified, with Maruti being the highest, and then Tata Motors and JLR and Bajaj Auto and all. Now, if we see the revenue, so please note this point,
there's a group revenue and there's a company revenue. The group revenue is not what gets reported in the financial statements or you will see on the screener. Part of that group revenue based on the shareholding comes to the listed Talbros Auto, and then it gets there in the financial statement. So this number which you are seeing, this is the group revenue. This is not exactly Talbros revenue, but proportionally, this is how the revenue would flow into Talbros. So basically, if you look at the growth, the idea is to look what has happened in FY22 versus 23. Most of these segments have grown very well. But if you look at 4-5 year history, and I will show you, some of the segments are not growing that well. But this is how the revenue is distributed in terms of gasket and heat shield, forging, chassis, and then some other component like anti-vibration component. This is only through this JV. This chassis component, your axle and all this is all Marelli JV. And then you have the standalone Talbros, which does forgings and gasket. And there is a JV also, which supplies gasket. So this plus this is the standalone. This is the Marelli JV, and this is the NLT JV. And the numbers look good. I think some 650 crore is what is flowing into Talbros, because you can add the standalone, you can add. So 300, 200, 500, 580 crore. And then these are 50-50. So 165, 220, 290, 290 ka 50% is 145. So almost 600 and 155. I think maybe it should be around 750 crore. That is how you should look at the group number versus listed number. If we look at the history, sales growth has been okayish. Like last 3 years have been good, but let's look 5 year, because in 18-17 and the last auto cycle peaked. So from last peak of auto cycle to now 10% kind of sales growth rate. But the PBT growth rate, PAT growth rate, EPS, these are good. Cash flow, I see a concern, and I will talk more about it. It's not like they don't have cash flow, but again, the kind of cash flows I want, somewhere this company, I'm not very happy. So I'll talk more about it. And you can see almost 270, last 3 years, they have generated 120 crore of cash flow, EBITDA to cash flow. So as I said, I like this number to be above 70%. This number is lower than my standards, but I'm still tracking it because of the growth story they're talking about and the valuation which we have despite of this cash flow. But if this number doesn't improve, then I will not, add it to the, A quality businesses. And then you have a lot of capex going into it, and all this growth is coming from this capex. And one reason why they don't have a very strong cash flow is basically it's a working capital little heavy business. If you see receivables versus inventory, now this is where companies like SJS or Menon, those kind of companies, if you see that they are able to convert 75% into cash flow. Now these are the small nuances we have to take care. However, it reflects in valuation also. It's available at a single digit, and we'll talk more about it. If we look at the TTM performance last 6 quarter, you can see everything is improving. The margins, the growth, everything looks decent. EBITDA margin, if we look at the history, so actually they have been improving. Like if you look at the 8-year mean, core EBITDA 11%, then 12%, then 13%. So there's a continuous improvement in last 10 years, whatever margins you look at, and that has come because they've been able to reduce their raw material cost, and they've been able to reduce their employee cost and salary cost. But still, it's a working capital heavy company. Still, they have almost 25% working capital to sales. But pretty decent balance sheet. You can see very less borrowing, and the asset side is also fairly diversified. Not very asset heavy, but more working capital heavy, which you can see if you add your receivables plus inventory. So you see how much of your portion these two are taking. That's the one big demerit I found in this company. And it's not improving. Actually, it's around the same 55-57%. And they're doing almost 40 crore of cash flow from operation. So that's the number. Now, if we look at each of these JVs, so as I said, when you look at 1 year data, it looks very interesting that everything has grown. But when we look at 5-year data, you can see the kind of fall it had. And this is where in 18 auto cycle peaked. So this JV has not done that great, but the Marelli JV is doing good. These years we need to ignore because your auto cycle peaked and then you got your COVID. But post-COVID, this business, so one, this business didn't go down when auto industry went down by 14-15% post-COVID. And then in during the COVID, and then once the recovery post-COVID happens in auto, this has really done well. And this other business also was fairly okay because 52 to 41, it was more like the COVID impact on auto sector, but then it has really bounced back well. But this business is something which I don't see going well right now. The other thing is, if you see post-COVID opening, they have done really well. And this is the kind of jump which has happened in numbers. In fact, I have a longer history. Let me first show you that. So this is the number of this company from 2003. And you can see this company had a good and bad time in phases. So 3 to 7, they did really well, from 72 crore to 181 crore. But then when the global recession, they also suffered and the growth stopped a little bit. But it was not only recession. I think it was also to do with, some kind of capex, because when you look at the cash profit, the numbers were not that bad. Your cash flows were still maintained. Same happened again. They grew for 3-4 years and, this happened. And again, if you see, I think most of the times my understanding is the cash flows were not impacted. It was more PAT impacted because of the expansion, and hence your depreciations were hit, but still your cash profit, cash flow from operations was good. And if you look, they have improved their balance sheet. They've improved their cash flows. If you look at the balance sheet during this period versus this period, I mean, so many times we use historic valuations, like we use historic mean P is this. But why I want to highlight is you have to also look what was the kind of balance sheet at that time versus now. What is the comfort? The chances to default here versus here versus here versus right now is relatively very, very less. So we have to factor all these things. Let's go back. Now, why we are studying it? So when I look through the investor presentation and the conference call, and this is the full year number. So this is the statement: with continuous innovation in new product like heat shield, strengthening EV portfolio, growing orders from non-automotive segment like Cummins and all, strong clientele. We plan to more than double our revenues and become a 2,200 crore company at group level by FY27. So this is the statement they have made. And if you see, this is a 650 crore company here. So you saw the group revenue was some 1,000 crore, right? So the group revenue was 1,037 crore. From 1,037 crore, they are talking about a target of 2,200 crore by FY27, which is 4 years down the line. And if we assume same kind of revenue will flow, even at a listed company level, this target could be, anticipated. Also, they're telling over the years, we have increased our focus on exports and continue to do so. And by 2027, we plan to have at least 35% through exports. So currently they have 25% through exports. They're expecting at least to go 35% in 4 years. And this will help to increase margins too. Our margin should also increase to 15-16% by FY27. So from a current 14.3% margin, they're giving 15-16% target. So just check about the numbers. Again, see, all this is basically the idea is to track. So the idea is to track such companies. Some managements will be good, some may not be so good. Some businesses may have a lot of headwinds, some will have less headwinds. But the idea is to at least have something in mind and then track it. So basically, we are seeing a company talking about doubling the revenue in 4 years, which means maybe a 16% kind of CAGR. I mean, you need to do the calculation, and a margin expansion, which means the profit to grow at more than 16%. So maybe 18% kind of scenario. And as I said, if we look at the cash flow, I know the cash flow conversion is poor. I am not happy. But despite of that, the company is generating 50 crores of cash flow, 51, 52 crore, 57 crore. So the company is generating 50 crore plus cash flow. And why I want to highlight is because the market cap is 646 crore. So basically, we are getting the stock at 10 PE for a management which is talking about 18% CAGR growth rate. And of course, once the size grows, the stock also moves from a smaller category to a bigger category. At this size, 646 crore, even, it won't even figure in Nifty top 750. 500, so no chances there. I don't think it will even figure in 750. But let's say if the company really grows and becomes a 1500 crore company, maybe if, the market cap increases a little bit, valuation increases, you might get this company around 2000 crore valuation 4 or 5 years down the line. So who knows, it might figure out, it might interest certain mutual funds and all. But right now at this level, these companies are not tracked. Again, similar to Men and Bearing, these kind of companies are not tracked by institutions. It is basically tracked by, investment advisors, big individual investors and all. But here we are talking about a decent 10 times cash flow valuation, and growth expectation, what management is aspiring for, is around 18-19%. Also, they have a very clearly defined plan how and they will reach to this revenue number. And first thing which they have given is they have an order book right now of more than 1000 crore. And this is the breakup of this order book. So 400 crore has come from totally new segments, like they have entered into agri construction off-road segment. So these are the new segments which are giving this order book, and 18% is off from the EV side. Same way, this 420 crore is coming from an EV order, which is where there is a 160 crore EV order for 5 years. Then the business, some of the businesses which were not doing good, there also they have got a good order book. So this gives some idea that, okay, at least they are not talking in air. They have some order book to talk about. And in terms of growth opportunities, so as I said, this Marelli JV is very, very important. I mean, when you talk track SJS, when you track Pricol, many places you will see this name. Marelli is a big name globally. So if there's a 50-50 JV with Marelli, and if you read through con calls, some places they say to some of the customers, they are the single supplier. That is the kind of trust they have built. This is one place where they're expecting some of the EV business to emerge from this Marelli deal. And some of these businesses which are very, very small, like EV, which is 2%, they're expecting by 2027 this to go to 12%. So these are some of the growth drivers. Then what is existing and what is planned for future. So this gives you a complete idea of what they are doing right now and from where they are going to expect the growth to come. So these are the slides which we should keep in mind to track the business, and in future, if we are attending the con calls and ask questions to the management, this will give idea of, how to track and what to ask. And in India, in gasket, they have almost a 50% market share, which is almost 3x more. This is what they say in the PPT. I don't have an alternate way to verify, but this is what is mentioned in the PPT. Again, the export business, they have told. So export business, if we see, they are telling that this will grow to 35%, which is a big number. As I said, they are a single source of supplier for 5 customers. It can become a risk also when customers want to diversify. But on the other side, this also highlights the kind of confidence the client have in them. And yeah, all the order book plans to grow revenue by 13% CAGR to 7. So this is regarding each of the businesses. So this is more on the gasket side. Then this is more on your, the other one, which is your forging business. So all the businesses, if you see, they are giving the numbers. So if they have a target of FY27, they're telling to achieve that target in FY27. What is the growth they are expecting for the gasket business? What is the growth they are expecting for the forging business? So For every vertical, they have created a leader and they have a well-defined target for that vertical, and then they are summing it up, and then they are telling, okay, this is our overall target for FY27, which makes us easier to track how they are progressing, where they are progressing. And these are the capacity utilization levels. They have also defined a CapEx plan to reach this target of 2027 for each business unit. This is the CapEx plan. I mean, for a 650 crore company, I never found a company which has given so much of clarity. At least, I mean, I don't know if they will do all of this, but it's good that somebody is having this kind of clarity and they have a well-defined plan how they want to achieve it in terms of each business segment revenue target, each business segment CapEx allocation and all of that. And it turns out to be a CapEx of almost 30 crore per annum, and 50 crore is the cash flow they are generating. So they expect all these CapEx to happen through internal accruals. Now, after going through so many presentations, I respect balance sheet, I respect cash flows. I like it more when all the CapEx happens through internal accrual rather than taking, debt. And a minimal debt is okay, some debt is okay, but it's good when they don't even need to take because they're self-sufficient. So this is the plan. Again, we need to track this plan. And finally, how this will happen. So if we summarize everything, basically you will have an export, which they want to take it from 25% to 35%, which will be margin accretive, which means they plan to increase the margins by 1 to 2% on EBITDA level, and through which they want to reach to a 20% ROCE. And all this they want to achieve by being still under 100 crore of debt. I think right now also they are around 60-70 crore, and they want to keep it there for more working capital needs, because you saw it's a working capital heavy business. So if we convert all of this into some kind of number crunching exercise, 62% of the group revenue is listed company revenue, and they have given a target of 2200 crore group revenue, which means if they achieve this target, basically the listed company revenue in FY27 will be 1364 crore, which if you convert into CAGR and analyze, it will convert into 20% CAGR revenue for 5 years. And currently they are operating on 8.5% PAT margin. So given they are giving a 1 to 2% increase, I have taken a 0.5% increase. And let's say if it happens from 8.5% to 9%, which is 50% lesser than the lower band of the target which they have given, because against 14.3%, their target is 15 to 16%. So if we take a mean, which is 15.5%, it's a 1.5% lift on the EBITDA margin, which means a bigger flow will happen at a PAT margin. So I'm being very, very conservative just to take a 0.5% increase. This translates into 123 crore of PAT. Now I know that currently the stock trades at 11 PE, but I think somehow if the company performs, is these numbers are achieved. I mean, this kind of number is not something which many companies do. So let's hope that if it gets a sustainable 15 PE, then it becomes 1845 crore valuation from current 646 crore valuation, which converts into a 30% CAGR for 4-5 years. If we give a 30% discount, let's say they don't achieve, they are 20-30% short of it, or let's say they are achieving it, but they're achieving it with 1-2 year of delay. So for all of that, after first level of building conservatives at the PAT margin, I'm just building one more conservative estimate, directly write off 30% of this target, which will convert into a 21% kind of CAGR. So this makes it worth tracking. I don't know if they will achieve what they will achieve, how the cycle will play out, but I'm adding it to the list of companies I want to track. And there was a question on, EV, whether EV is a threat and all. So this is where they have responded. It's a new company to me. I have not tracked in detail. I think this company became very popular because Vijay Kedia ji sir, he made almost a 6-7 bagger in 2 years in the post-COVID cycle. So on EV, they are telling we have already started supplying to EVs in India as well as globally. There is a little bit of question mark on two-wheeler. So they're telling whatever EV risk is there, little bit of risk is there in the two-wheeler, where at an overall level, they're telling the overall revenue level, there might be a 5-10% impact. They have not given exact number, but the message they want to convey is the EV impact may happen on a portfolio on two-wheeler, which they will recover through all the other growth items which they're projecting. So net, they are telling we have factored in all of this while coming up with this kind of estimate. I did look at the related party transactions also. More or less it looks okay, except some royalty income, which might be okay because they might be getting some kind of technical know-how from these foreign JV partners, and hence they might be paying some royalty, which is not very high. It's 1 crore, which looks okay. Sale of goods is to the JV. My sense is to the JV. So that is how it is happening. Gross profit margin is only place where I feel there is a risk, because they have never executed this kind of gross margin. But if we look at the history from a 2% margin companies to slowly they got into 4%, then again cycle change, now 7%. So I'm a little scared of this margin cyclicity. And then they're telling they will be able to increase margin by further 1-2%. The only thing which is giving me some solace is, if you see this margin improvement, primarily this margin improvement, has happened. One, because if you see the gross margin has been same. If you see this year, the PAT margin was very low, but the PAT margin reason was not the gross margin suffering, but the items below the gross margin. And usually I have seen those items management has relatively better control. It's the cost of goods sold where management doesn't have a lot of management, they don't have control. And especially if you see here, bulk of the raw material is basically steel driven. So, and we know the steel had a good cycle post COVID, and from last 6, 7, 8 months, 10 months, now steel is depressed. So even in that cycle, I saw the gross profit margin was retained, which gives some confidence that they will be able to retain the margin, maybe because they have got into forging and some better businesses, Marelli business, they have been able to maintain. But this is the only thing which gives me confidence. But still, one, cash flows, and second, the lifetime high margins. These are the two things which makes me a bit worried. These are the numbers, how each of these businesses have grown for 8 years. So if you can see, forging has really done well, where forging revenues have tripled. Gasket, it has not shown that kind of growth rate. It's an old business. It has also grown, but not that great growth rate. The bulk of the growth rate has come from forging side. And these are some of the investors, like I think Dolly Khanna, then Vijay Kedia sir. So you can see these numbers.
And if you want to know about many such companies in detail, we have a practitioner membership program where we have almost now 120 plus hours of content. We have covered almost 80 plus such companies. We have covered almost 8-9 such sectors. We cover similar kind of quarterly analysis at a much more higher scale. We have much more detailed analysis. We have valuation models, Excels, and lot more. So do explore the practitioner membership program. So I hope you liked this video, and I hope you got few interesting companies to track for future. If there are more such interesting companies which you have come across where there is some guidance, there is some indication from the management that they will be growing 15-20% plus, do let us know and we will try to cover it on our platform. Thank you.